Turning back to the markets, of course, they have closed. Now, let's check in where they closed. Lower, but relative to the extraordinarily large move in oil prices, you would say not that low. The Dow down 0.5%, S&P down 0.3%, as was the Nasdaq. Russell slightly higher. Energy, of course, the best performing sector, up 3%. You saw real estate, materials, consumer discretionary lower. And Sarah, with that move in oil, we did see some safe haven trading like the dollar higher, the yen higher, and some buying of bonds. But again, very small moves in all of those risk-off trades relative to the huge jump in oil prices.
I was watching the consumer discretionary space. It did get hit, down 1.2%. That's where you would expect to see the pain. The whole story lately has been the strength of the U.S. consumer. That's what's holding the economy up. So let's see if the U.S. consumer can deal with a sort of oil supply shock. In previous points in history, that's been painful, and it's caused recession. So that's going to be one of the questions. Joining us to talk about the market today, Mike Santoli, CNBC senior markets commentator as always. Keith Bliss is still here, managing partner and CEO of IQ Capital USA. Alicia Levine, chief strategist at BNY Mellon Investment Management. And Paul Cheng, managing director and senior equity analyst at Scotia Howard Weil. We have a lot to get through today. Mike, set us up, though, in terms of that reaction that everyone's having. The market was only down this much, given such a big spike in oil.
It really, overall market absorbed it without much trouble. Actually, more stocks up than down today. The equal-weighted S&P was flat today. So it really was a matter of what worked and what didn't, as opposed to the overall market taking a hit. On the news, obviously, the energy sector getting a huge lift. But within consumer discretionary, Sarah, I would note the dollar stores down 3% each. So that was really very acute because, of course, Amazon also down almost 2% on a Wall Street Journal story.
It also has GM, which was down on the strike.
And the cars don't help either. Anyway, but to your point, it was more about where we took. I wouldn't have been surprised after a 6% rally to the cusp of an all-time high if we were down 1/3% in the S&P today with nothing having happened over the weekend. That's how much we were down in the end. So, you can't call anything over. If oil keeps surging in a hurry, and it's just because of supply disruption, that's not bullish. But at this point, anyway, it didn't really disturb the overall picture.
Alicia, what was your take on this lack of more selling from broader equities?
So the first thing is that if this had happened 40 years ago, this would have been shocking, and the oil would have been up 25-30% in one day, and the market would have probably come down much further than 0.5%. The thing is that we've got excess reserves globally that can actually make up for the 5%, the 5 million barrel a day shortfall for the next 3 months. So there's enough excess reserve out there, particularly coming from the U.S. So in the worst case scenario, if Saudi can't get supply back on the next 2 or 3 weeks, we actually can supply to keep oil prices relatively stable. The other thing just about the S&P is that the energy sector now only makes up 5% on a market cap weighted basis of the S&P. And so that's why the S&P wasn't really up at all with energy running the way it did today. It's just a much smaller part of the S&P.
Still, it raises the question, Keith, about how long this will take,
right,
what the next steps will be from Saudi Arabia, potentially from the United States, where Iran stands. I mean, these aren't questions that are going to get answered overnight. So would you be buying oil stocks on this?
I think I would be staying away from oil stocks because we've got the commodity overbought from today's trade. So I honestly think that this is we'll wash over a little bit. We'll get some more facts coming out. There will be a response from Saudi Arabia, maybe the United States. It will not turn into an all-out shooting war with Iran, in my opinion. And then you'll see the energy stocks start to come off a little bit, too. One point I did want to make, though, talking about just the trend in the overall market, you see that people want to own stocks in this. Because if you look at today's action, what we're talking about in digesting, there was not this massive sell-off. But look at the Russell 2000. It was the only index that was green today, and it has been outperforming for the last 30 days. You would think people would make the calculus, well, oh my gosh, if small businesses have to pay more for their energy spend, which they may likely do, that's going to be a big hit to their P&L, and then you pull out of those stocks. We did not see that today. People want to stay in stocks. They're just looking, to Michael's point, looking for pockets of where they can stay.
Paul, what's your take on what else to focus on for equities in the week ahead?
Well, first of all, thank you for having me. I think it's important to note that this attack is unprecedented. We at Scotia, Howard Weil, we believe that there's two important points to note. It's not only that the scale of the impact on the market, talking about more than 5 million barrels per day of oil, but also that for the first time in modern history, we can no longer be certain the oil infrastructure at Saudi Arabia is going to be safe and is always going to be there. And that means that going forward, the risk premium toward the market is going to be higher. Everything else equal, we should see the valuation for the U.S. and Canadian oil-producing asset going to be higher. Now, granted, the initial reaction probably overdone, and then we will see oil prices pull back. And some of the high fire is probably helped today by the short squeeze, especially in the mid-cap E&P names. And so we may see in a number of days from now, they're going to see pullback. But we think that on the overall, you're going to see higher valuation over the next 1 to 2 years comparing to what before that we are seeing in the market. And we think that as the market settles down, you're going to see the large cap oily E&P and the major oil companies like Chevron going to start outperforming the mid-cap E&P name. We also think today, the refiner is not doing well. We think that is going to pay catch up.